Preparing for an enterprise risk associate at Wells Fargo interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in enterprise risk at Wells Fargo? I am interested in Wells Fargo because enterprise risk sits at the center of a large, complex financial institution. The role combines analytical work, control discipline, regulatory awareness, and business partnership. I also see Wells Fargo as a place where strong risk management directly supports trust, customer outcomes, and sustainable growth. I would bring a structured mindset, curiosity, and willingness to challenge assumptions while helping business teams manage risk responsibly. While answering, focus on Wells Fargo's scale, regulated banking environment, ongoing risk transformation, customer-centered culture, and your interest in connecting controls, data, governance, and business decisions across the enterprise. Question 2. How would you define enterprise risk management in a banking context? Enterprise risk management is the coordinated process of identifying, measuring, monitoring, controlling, and reporting risks across the bank. In banking, that includes credit, market, liquidity, operational, compliance, model, strategic, and reputational risk. The goal is not to eliminate risk, because banks must take risk to create value. The goal is to take risk within appetite, understand concentrations, escalate issues early, and give management a clear view of the firm's risk profile. Make sure to cover the holistic view of risk, major risk types, risk appetite, governance, escalation, controls, and how helps leadership make informed decisions rather than avoid all risk. Question 3. What are the 3 lines of defense, and where would an enterprise risk associate fit? The first line owns and manages risk in the business. The second line, where enterprise risk typically sits, sets frameworks, provides independent oversight, challenges risk decisions, and monitors adherence to appetite and policy. The third line is internal audit, which provides independent assurance over governance and controls. As an enterprise risk associate, I would help the second line identify emerging risks, review controls, analyze metrics, and ensure issues are escalated clearly. In your answer, talk about first line business ownership, second line independent oversight and challenge, third line audit assurance, plus how collaboration and escalation should work without confusing accountability. Question 4. How do you assess whether a risk is within the bank's risk appetite? I would start with the relevant risk appetite statement and supporting metrics, such as limits, thresholds, tolerances, qualitative expectations. Then I would compare current exposure, trend direction, and control performance against those boundaries. If a metric is close to a trigger, I would not wait for a breach. I would look at root causes and likely trajectory. A good assessment combines data, business context, documentation, and timely escalation. Be sure to mention risk appetite statements, metrics, thresholds, limits, qualitative judgment, trend analysis, escalation triggers, and the importance of documenting assumptions and evidence behind the assessment. Question 5. Walk me through how you would perform a risk and control self-assessment. I would begin by understanding the process, key objectives, systems, handoffs, and failure points. Next, I would identify inherent risks and map existing controls to those risks. Then I would evaluate whether controls are properly designed and operating effectively using evidence, testing results, and issue history. After that, I would rate residual risk, identify gaps, assign owners, and set remediation timelines. The RCSA should be refreshed when the process or risk environment changes. While answering, focus on process mapping, inherent risk identification, control design and operating effectiveness, residual risk rating, evidence review, action plans, ownership, and periodic refresh of the assessment. Question 6. What is the difference between inherent risk and residual risk? Inherent risk is the level of risk before considering controls. Residual risk is what remains after controls are applied. For example, a payments process may have high inherent fraud risk because money moves quickly and across many channels. Strong authentication, Transaction monitoring, segregation of duties, and exception reporting reduce that exposure. Interviewers want to hear that residual risk is not automatically low just because controls exist. Controls must be effective and evidenced. Make sure to cover the before and after control distinction, examples from banking, why both ratings matter, and how residual risk supports prioritization, escalation, and risk appetite monitoring. Question 7. How would you evaluate whether a control is well-designed? A well-designed control directly addresses a specific risk and has a clear objective, owner, frequency, evidence trail, and escalation path. I would ask whether the control would actually prevent or detect the failure it is meant to address. For example, a monthly review may not be enough for a daily high-volume transaction risk. I would also examine whether the control has adequate precision, uses reliable data, and is performed by someone independent enough to challenge exceptions. In your answer, talk about control objective, risk coverage, preventive versus detective nature, frequency, precision, ownership, evidence, system dependencies, and whether the control addresses the root risk. Question 8. What is the difference between a control design deficiency and an operating effectiveness issue? A design deficiency means the control, even if performed perfectly, would not adequately mitigate the risk. An operating effectiveness issue means the control is conceptually sound, but was not executed properly, consistently, or with sufficient evidence. For example, if a control requires manager approval, but the manager lacks relevant data, that is design. If the manager had the data, but skipped reviews for 2 months, that is operating effectiveness. The fix depends on that diagnosis. Be sure to distinguish flawed control structure from failed execution. Include a practical example and explain why remediation differs depending on whether the problem is design, execution, training, or evidence. Question 9. How would you respond if a business partner disagreed with your risk rating? I would first ask the business partner to explain their view and the evidence behind it. Risk ratings should not be personal. They should be grounded in methodology, data, issue history, control performance, and potential impact. If their context changes my view, I would adjust. If not, I would explain my rationale clearly, document the disagreement, and escalate through the appropriate governance channel. The goal is constructive challenge, not winning an argument. While answering, focus on professional challenge, evidence-based discussion, listening to business context, aligning to methodology, documenting rationale, escalating appropriately, and preserving a collaborative relationship. Question 10. Tell me about a time you identified a risk others missed. In a prior project, I noticed exception volumes were stable overall, but one product segment had a sharp increase. Instead of relying on the aggregate dashboard, I broke the data down by product, region, and processor. That showed a training gap after a procedure change. I raised it to the process owner, helped build a targeted review, and the team corrected the issue before it became a broader control failure. Make sure to use a STAR structure. Highlight your analytical process, explain the risk signal you noticed, describe stakeholder communication, and quantify or clearly state the outcome if possible. Question 11. How do key risk indicators differ from key performance indicators? Key performance indicators measure how the business is performing, while key risk indicators signal changing risk exposure or control weakness. For example, loan growth is a KPI, but rising delinquency rates, exceptions to underwriting policy, or complaint volumes may be KRIs. A strong risk associate looks at both together. Rapid growth can be positive, but if risk indicators deteriorate at the same time, management may need to adjust controls, staffing, or limits. In your answer, talk about forward-looking risk signals versus business output measures, thresholds, escalation, trend monitoring, and how both can interact in banking decision-making. Question 12. What would make a KRI effective or ineffective? An effective KRI is tied to a material risk, measured consistently, available in time to act, and supported by clear thresholds. It should move when the underlying risk changes. An ineffective KRI may look impressive but not drive decisions, such as tracking a volume metric with no link to loss, customer impact, or control performance. I would also test data quality and ownership, because a metric no one trusts will not support escalation. Be sure to mention relevance, measurability, timeliness, sensitivity to risk changes, clear thresholds, data quality, ownership, actionability, and avoiding vanity metrics that do not drive decisions. Question 13. How would you investigate a sudden increase in operational losses? I would first validate the data to confirm the increase is real and not a reporting or classification issue. Then I would segment losses by event type, business line, product, location, process, and root cause. I would compare current levels to historical trends and thresholds. Next, I would review related control failures, open issues, staffing changes, or system incidents. If the impact is material, I would escalate and help define corrective actions with clear ownership. While answering, focus on loss event categorization, trend analysis, business line comparison, root cause review, control failures, data validation, management action plans, and escalation based on severity. Question 14. What is issue management and what does good remediation look like? Issue management is the formal process for capturing, assessing, remediating, and validating control gaps or risk events. Good remediation starts with the root cause, not just the symptom. The action plan should have an accountable owner, realistic milestones, evidence requirements, and a sustainable control enhancement. Closure should require independent validation that the fix works. In a bank, weak issue management creates repeat findings, regulatory concern, and avoidable operational risk. Make sure to cover issue identification, severity rating, root cause, corrective action plans, accountable owners, milestones, validation, sustainable closure, and avoiding superficial fixes that do not address causes. Question 15. How do you prioritize multiple risk issues with limited resources? I would prioritize based on severity and urgency, not just who asks the loudest. Factors include customer harm, regulatory impact, financial exposure, likelihood, velocity, control failure severity, and whether the issue is already outside appetite. I would also consider dependencies, because fixing one root cause may resolve multiple symptoms. Once priorities are set, I would communicate trade-offs clearly, document the rationale, and keep stakeholders updated on milestones and risks to delivery. In your answer, talk about materiality, customer impact, regulatory impact, likelihood, velocity, financial exposure, control weakness severity, deadlines, interdependencies, and transparent communication with stakeholders. Question 16. How would you explain credit risk to someone outside finance? Credit risk is the risk that a borrower will not repay as agreed. For a bank, that could mean a consumer misses loan payments or a company defaults on a credit facility. The bank looks at ability to repay, collateral, exposure size, and economic conditions. In simple terms, credit risk combines how likely default is and how much the bank could lose if default happens. Strong credit risk management protects earnings, capital, and customers. Be sure to define default and loss risk simply. Mention borrower capacity, collateral, exposure, probability of default, loss given default, and why banks manage credit risk carefully. Question 17. What is liquidity risk, and why is it critical for a bank like Wells Fargo? Liquidity risk is the risk that a bank cannot meet cash obligations when due without unacceptable losses. For a large bank, that includes deposit withdrawals, loan funding, debt maturities, and market stress. Liquidity is critical because banking depends heavily on confidence. Even a solvent bank can face pressure if funding becomes unavailable. That is why banks maintain liquidity buffers, diversify funding, monitor cash flows, and run stress scenarios under regulatory expectations. While answering, focus on the ability to meet obligations, deposit behavior, funding sources, stressed conditions, liquidity buffers, regulatory expectations, and confidence as a core banking risk factor. Question 18. What is model risk, and how should it be controlled? Model risk is the risk of loss or poor decisions from incorrect model outputs or inappropriate model use. A credit scoring model, for example, may perform poorly if borrower behavior changes or input data is weak. Controls include model inventory, development standards, independent validation, documentation, performance monitoring, change control, and user training. The key is remembering that models support judgment. They do not replace accountability for decisions made using their outputs. Make sure to cover incorrect model outputs, misuse, assumptions, data quality, validation, documentation, monitoring, governance, and examples such as credit scoring, stress testing, or fraud detection models. Question 19. How would you approach a new regulatory requirement affecting a business process? I would begin by understanding the requirement and confirming interpretation with compliance, legal, and risk partners. Then I would map which products, processes, systems, and controls are impacted. After a gap assessment, I would help define required policy updates, control changes, training, reporting, and implementation milestones. I would track progress with evidence and test whether changes operate as intended. Regulatory change management should be organized, documented, and sustainable beyond the initial deadline. In your answer, talk about requirement interpretation, impacted processes, gap assessment, policy updates, control design, stakeholder coordination, implementation tracking, testing, evidence, and ongoing monitoring. Question 20. Describe a situation where data quality affected a risk assessment. In one analysis, exception rates appeared to improve significantly, but the trend looked too clean compared with prior months. I traced the source file and found one region had been excluded after a reporting change. That meant the risk dashboard understated open exceptions. I flagged the issue, worked with the data owner to correct the feed, and restated the metric. The experience reinforced that risk reporting is only as strong as the data controls behind it. Be sure to use a concrete example, explain the data defect, describe how you detected it, state the effect on risk reporting, and show how you corrected or escalated it. Question 21. How do you perform root cause analysis for a control failure? I start by separating the event from the cause. If a review was missed, the cause may not simply be human error. It could be unclear ownership, poor system alerts, excessive workload, or weak procedures. I would review evidence, interview process owners, map the workflow, and ask repeated why questions. The final root cause should be specific enough to drive remediation. Otherwise, the fix becomes generic training, which often does not prevent recurrence. While answering, focus on moving beyond symptoms, using techniques like 5 whys or process mapping, considering people, process, technology, data, governance, and linking root cause to remediation. Question 22. What would you do if you found a potential risk issue close to a reporting deadline? I would not ignore it because of the deadline, but I also would not overstate an unvalidated finding. I would quickly gather the key facts, assess potential severity, preserve evidence, and notify my manager. If the issue could materially affect reporting, customers, compliance, or risk appetite, I would recommend escalation through the defined process. In the report, I would clearly distinguish confirmed facts from items still under review and document next steps. Make sure to mention validating facts quickly, assessing severity, notifying your manager, preserving evidence, avoiding unsupported conclusions, documenting assumptions, and escalating based on governance requirements. Question 23. How would you balance business growth with risk management? Good risk management should enable responsible growth, not simply say no. I would start by understanding the business objective and the risks created by the growth plan. Then I would compare the proposal to risk appetite, identify control needs, and suggest monitoring metrics or limits. For example, faster loan growth may be acceptable if underwriting quality, staffing, and delinquency indicators remain strong. The best outcome is growth with clear guardrails and early warning signals. In your answer, talk about enabling responsible growth, not blocking business activity. Using risk appetite, controls, monitoring, scenario analysis, customer outcomes, and early partnership with the business. Question 24. Tell me about a time you had to communicate a complex risk topic to senior stakeholders. I once had to present a control testing issue to leaders who were not involved in daily operations. I avoided technical detail up front and framed the message around impact, root cause, exposure, and decision needed. Then I used a simple trend chart and one process example to explain the issue. That helped the group approve additional remediation resources quickly. Senior stakeholders need clarity on why it matters, what is being done, and what decision is required. Be sure to structure the story around audience awareness, simplifying without losing accuracy, using concise visuals or metrics, recommending action, handling questions, and showing impact from your communication. Question 25. What qualities make someone successful as an enterprise risk associate at Wells Fargo? A strong enterprise risk associate combines analytical discipline with sound judgment. The person needs to understand data, controls, policies, and business processes, but also communicate clearly and challenge respectfully. Integrity is critical because risk professionals must escalate issues even when the message is uncomfortable. At Wells Fargo, I think success also requires customer focus, regulatory awareness, strong documentation habits, and collaboration across lines of defense, while maintaining independent perspective. While answering, focus on analytical ability, professional skepticism, communication, integrity, collaboration, regulatory mindset, attention to detail, comfort with ambiguity, and willingness to escalate concerns respectfully. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.